All right. Hello, everyone. My name is Colin Brown. I'm with NACVA and the Consultants Training Institute. We want to welcome each of you to Hardball with Hitchner, solid answers to tough questions. A few housekeeping items. First, you can obtain CPE credit for the session by answering all the poll questions that will pop up on your screen. I will play this sound. Uh-oh. There we go. I will play that sound whenever a poll is launched so that you know that it's been launched. And just be attentive and respond promptly to the poll questions. CP certificates will be available on the nacva.com portal in 3 to 4 weeks after the conference. If you have any questions during today's presentation, you'll be able to submit those questions into the Q&A section of your Zoom toolbar. Please use the Q&A option for relevant questions for our presenters. If you do have a generic comment, a technical question, or a poll question, you can use the chat feature for those, as those types of questions will be directed to me. Now it's my pleasure to introduce our presenters today. We have Jim Hitchner, is the Managing Director of Financial Valuation Advisors and is President of Financial Consulting Group. He is also CEO of Valuation Products and Services, which created and distributes the Business Valuation Standards Compliance Kit, the VPS DLOM Guide and Toolkit, the Hitchner Pratt Fishman Consensus View Q&A Guide to Financial Valuation, and presents monthly webinars. Jim is also an accomplished author and instructor, having authored and co-authored many books and is presented at over 200 conferences. Then we have Chris Mellon. He's the Managing Director of Valuation Research Corporation, leading its Boston office. Prior to joining VRC, he was the president and founder of Delphi Valuation Advisors, which he ran for 15 years and sold to VRC in July of 2015. Mr. Mellon specializes in the valuation of closely held businesses, professional practices, and intangible assets. His experience includes completion of approximately 2,800 valuations of such entities and assets over the last 27 years. Then we have Don Drysdale. He's the managing member of Gibraltar Business Valuations and has been performing business valuation and related services for more than 23 years. In addition to being a CPA, he holds the ABV and ASA designations. His experience spans the spectrum of industries, and he is a contributing author to the book Valuation, Financial Valuation. Last but not least is Roger Grabowski. He is the Managing Director of Duff & Phelps and an accredited senior appraiser and fellow of the American Society of Appraisers. The FASA is their highest designation. And Mr. Grabowski was formerly the Managing Director of the Standard & Poor's Corporate Value Consulting Practice, a partner of PricewaterhouseCoopers and one of its predecessor firms, Pricewaterhouse. He is co-author with Shannon Pratt of Cost of Capital, Application and Examples in its 5th edition. That's published by John Wiley and Sons, and The Lawyer's Guide to Cost of Capital. He is co-author of the Duff & Phelps Annual Resources for Cost of Capital Data, Valuation Handbook, Guide to Cost of Capital, Valuation Handbook, Industry Cost of Capital, International Valuation Handbook, Guide to Cost of Capital, and International Valuation Handbook, Industry Cost of Capital. And with that, I will turn the time over to these fine gentlemen.
Thank you, Colin. We'll start off one of the first questions, and we did some of this yesterday when we did the hardball session, and it was an interesting discussion. But I mean, I believe that in general, COVID-19 was known and knowable, the effect on BV a little bit past mid-February. So it could be some discussion, but sometime in February, I think what most people are saying. I believe it's February 24th, but it is, other people believe sometime in February. Now, what if you're doing a valuation on February 1st, 2020? And let's say it's for a divorce, and you're working for the in-spouse. The owner of the company is the in-spouse. You're gonna be under pressure from the attorneys to do a valuation with COVID, because it's going to be a lower number. And or if you're working for the out spouse, they're going to want it before COVID was known and knowable because it's going to be a higher number. Don, I'm going to ask you the question. What do you do and it's not just divorce, it's other litigation as well and other jobs. And some of it's positive with the state and gift tax. But let's just say with the divorce example, Don, what are you doing with attorneys? I mean, I'm telling attorneys, you know, that I'm not sure if I do a February 1st valuation of a company and COVID's not known or knowable, of what use is that to a trier of fact? Mostly in divorce, it's not jury trials, it's a judge trial. Because judges, you know, attempt to be fair and in their courts of equity. So Don, what do you think about that? Are you counseling with the attorneys about the dates and with COVID, not with COVID?
Yes, I am. And I just got done testifying in a case where COVID was an issue, PPP loans were an issue. This was a little bit subsequent to the date that you're talking about. But yeah, counseling with them and instructing them, letting them know what the relevant issue is of known or knowable as of that date. And I'm kind of with you on that. I'm early February, it wasn't, I mean, we knew it was out there, but it wasn't something that was really on anybody's radar. What was happening then was all the impeachment stuff. And so everybody's attention was drawn away from COVID at that point in time.
But if you really research, if you really look at the research, even though the press, the popular press wasn't focused on it, the beginnings of the pandemic preceded February. And I think if you really looked at it carefully, while you certainly couldn't determine the magnitude, the risk was there. And from December on, it was in the sort of the intellectual press about, let's say the back page of the Wall Street Journal and, the back page of the New York Times, not the front page, but, you could make a case that there was the likelihood of some problem as soon as it became evident what was going on in Wuhan, China.
Yeah, one of the things is, particularly if you're doing international valuations and your supplies are coming, your supply chain comes out of China, which is a lot of industries. We knew about Wuhan years ago. Not years ago. In beginning this year, some people say the latter part of 2019. But then I look at the effect on valuation. We knew it was there, but we didn't know the effect on valuation. And interesting enough, in February, the S&P 500 and the Dow Jones reached their highest level ever. And the Russell,
I agree. It was not evaluated in that light, but I think you could make a case that there was some probability that there was going to be some issues. Certainly not to the extent of what ended up being even in late February, March.
Yeah,
but
pretty hard to predict what's going on now. But Chris, getting back to the what are you doing with attorneys? I mean, if an attorney says, here's the valuation date, are you pushing back a little bit and saying, well, do you want me to do it both ways? And interesting enough, I'm about to publish something, should be out next week, a short article on this known or knowable, because there is an out. If a lawyer tells you, if you have a February 1st, 2020 valuation date, and you're going to tell the lawyer, well, I'm not allowed to use subsequent events, so I'm only allowed to use what's known or knowable, and you're going to have a lawyer saying, I don't give a damn what your standards are. All right, I want a valuation with COVID. Under USPAP and SSVS, there is an out. The out is a hypothetical condition.
Right.
You elect a hypothetical condition, and under that, you can do a with COVID as of February 1st, 2020. So Chris,
Yeah,
what are you
so
doing in terms with your lawyer?
I do pretty much what you alluded to in your question at the very beginning, and that is look at the market. The market really reacted around February 23rd, February 24th. What we've done is we've created a little index where it's a very simple thing to do. Actually, it's what is the industry that we're working in, and identify the public companies in that industry, and then track the market cap for those companies and compare them to both the S&P 500 and the Russell 2000. The Russell 2000 is looking at the small cap public stocks.
But excuse me for interrupting, but Russell 2000 small cap is real big to a lot of people.
Right, but smaller than
the other index.
And the S&P, yeah. So it's a proxy. And we actually, we've been, any valuation that we've been doing at this point, we've been looking to see how the industry is reacting and responding accordingly in our valuation. So there's wide swings. And I'll just give two examples. I have it in front of me. We were doing evaluation of a company in the logistics business with delivery and so on. And we're also doing evaluation in the cruise business. So the interesting thing based on the valuation date is how things change in the logistics business, and as one would expect in the cruise business, how things are down. So basically, since the market peak, the cruise, that index that we're measuring is down 64% as of, I just did it today, as of today. And it's been pretty consistent. It was at its worst on March 23rd, down 75%, but it's been between 53 and 75%, and mostly in the 60s on every month end that we've been measuring it. But the logistics business is a little different. At first, it went down. So, for example, at the end of April, it was down 23%. In the end of May, down 18%. I'm sorry, down 14% end of April, down 8% at end of May. But over the past 2 months, it's been up about 19-20%. So it depends on the industry, on how we're responding to it. In terms of a movable valuation date, because in litigation, as you know, in some shareholder cases, it could be, say, the date of termination, so it's fixed. But in a divorce, obviously, it could be a moving target. It really has to be, we have to settle on that. And if we can't settle on it, as now I forgot if Roger said or somebody said it, then we're going to do it both ways.
Yeah. Remembering that a matrimonial court is a court of equity. And, you can't, even if it's the hypothetical, let's say December 31st was the hypothetical valuation date, but the trial is in June. You can't, if the in-spouse is unable to pay whatever hypothetical might look like in December, I'm sure a judge is going to take that into account.
Yeah.
Because you can't get blood out of a turnip, and you could squeeze and squeeze. And the issue that you have for a lot of companies is what you observe for public companies are many companies that were able to stay in business because they could borrow. And they went out and borrowed money. There's a lot of private closely held businesses that don't have access to the capital markets the same way. And they're hurting in a completely different way than the public companies are. Because the public companies, and you can see this in the statistics about how much debt public companies raised this year. It's phenomenal how much they raised. And yet the closely held business that requires getting capital from the banks are being shut out. So you've got this dichotomy of whether or not the company, the entrepreneur, the in-spouse actually can afford whatever, hypothetical it is, hypothetical payment.
Yeah, and when you're talking about, I'm going to echo Chris a little bit of Roger. We're reading the NDAs of public companies in the industry pretty closely now. And we read them before, but they're full of information. Some of them are fuller of information than others. All right, there's practitioners out there. I'm gonna throw this to you first, Don. There's particular practitioners out there saying, and they said this with TCJA too, and I refuted it, but I'm not sure I'm refuting it as much under COVID, is the capitalized cash flow model temporarily dead? Don, why don't you lead off?
Well, I think can be industry specific.
Let's assume that we're in a company in an industry with a negative impact. There are some companies with positive impacts, but let's talk about negative impact. I'm sorry, go ahead.
In that situation, I would prefer to do a DCF methodology, because you can, but the question is, when does it recover? That becomes the difficulty with the DCF. I mean, we have a difficult situation either way. I guess you could potentially, in a capitalized cash flow method, you could take the growth rate and you could do a kind of a blended growth rate of what you think growth and cash flow is going to be over time, and apply that to your capitalized cash flows. But the difficulty in the DCF also is, in this environment, especially with a company that is highly impacted by COVID, when do they come back? When does that cash flow return to normal? And those are questions that are difficult to answer.
Okay, I'm going to go off on a tangent here, but I want to hear the other panels. One of the best resources anywhere on what's going on COVID, both U.S. and worldwide, is McKinsey, and it's all free. McKinsey last week put out when they think the recovery of industry sectors would take place. I've never seen anyone else do it. And McKinsey's been doing forecasts, and also I like the Congressional Budget Office, and they do a lot of stuff. They just redid their 10-year forecast. They usually only do it once a year, but they just redid their 10-year forecast. So I'm relying more on what the so-called professionals, forecasters, are doing, because they have more resources than I do. But what about you, Chris? Are you doing capitalized cash flow? Do you think it's temporarily dead?
I think saying it's dead is a bit strong.
I did say temporarily.
Is it greatly diminished? Absolutely. Look, if there's going to be a change, a capitalization of cash flow is an abbreviated DCF.
Yep.
So, in some cases, you might have to forecast out 1 year and then capitalize it. You've got to look at the specifics, as Don was saying. We rarely do cash flows, and even in general, I don't know that we've done. We might still do one for very specific reasons. For a very steady business, and then just treat the PPP loan a little bit separately. When we do valuations, we're always, whether we present multiple scenarios or not is a different thing, but we're always doing multiple scenarios and ultimately presenting what makes the most sense.
Well, one of the things that people need to realize is you don't have to do a 5-year DCF.
Right.
I mean, a lot of us are plugged into you can do a 2-year or a 3-year.
Exactly. It's about when you're best, the answer of the number of years, when people ask, how many years should I go out for a DCF? The answer is not a number. The answer is when you feel that your best forecast is a steady state rate of growth of between, 2 and 5%, and usually 3 or 4%. And that could be in 2 years, it could be in 5 years, it could be in 10 years. That's the qualitative side of valuation and the analysis and understanding the business, understanding the industry and the trends, looking at those projections, and deciding from there. 5 years.
Do you have any thoughts on? I know you guys at Duff and Phelps don't do a lot of small companies, but where CCF is used more often. But what are your thoughts on it? Is capitalized cash flow, you think, temporarily dead for companies that have been negatively affected, or I guess could be temporarily positively affected too? But what do you?
But yeah, in both cases, you've got to evaluate the scenarios. Let's use one that everybody probably would be very familiar with. Let's talk about the NBA for just a second. As an example, here you are with basically no, they lost a bunch of the season this year, out of this year. They have no fans, so they have no revenues from attendance. It's just TV revenues. Now, what's the scenarios that might happen next year? You can sort of look at the alternatives. One is that during the first third of the season, 25% or 50%. Okay, those would be two scenarios, maybe equal. That is 25 or 50% attendance. And gate revenue for some teams is very, very critical. But that scenario isn't going to be 100% for the first half of the season. And it probably won't be 100% for the second half of the season, because you'd have to have everybody be vaccinated to be able to have these stadiums go back to 100% for the NBA. So I'm using that as an example where I think if you sit down and you look at the scenarios, and it forces you to sort of consider the alternatives that might happen, then you can start weighing them. What is the highest to the sort of the lowest? I hate to use probability as a probability, but certainly by rank, what might happen. And then it sort of gives you you've got to build it up. And because there's so much uncertainty when, for every company, when is normalcy going to occur? Are we going to have a reoccurrence? I mean, look at what's happened with the reoccurrence in California, where they've gone from no masks back to everybody's got to have a mask, and and the number of COVID cases. So I think it behooves us to sort of lay out in each industry what are the logical steps that might occur under various scenarios, just to build our comfort level in terms of coming up with a projection. And I dare to say, for most smaller companies, you're never going to get management to give you a projection as to when this is going to occur. It's going to fall on us.
Roger, I've heard, are the auditors pushing for probabilistic scenario analysis for fair value for financial reporting?
They certainly, I don't know if they're pushing it, but there's certainly in the toolkit that in uncertain times and about uncertain assets, that it's sort of an available tool that it helps. It actually helps give the auditors comfort that you've considered the various possibilities in coming up with it.
But one of the things, I have seen some probabilistic projections out there, and some of them, you know, one of the probabilities is 15%. I think that's crazy. I mean, I'll tell you what we're doing. We're looking at, can we do a 50-50 on COVID comes back, second wave, or it doesn't? And then we're also looking at 3 ways. I mean, I've been seeing people with, you know, 3. I don't believe, you know, unless you got a large chance of liquidation, I don't really believe in 5 or 6 or 7 scenarios and probabilities. But some people are using 3. But when someone's saying 15% for this and 40% for that and 45, I mean, that to me sounds like you're trying to produce accuracy that doesn't exist.
Yeah.
So I'm more of a fan of, give me a 50% projection and I'll help you put it together. I agree with Roger, they're not just going to do it. And then what's your upside 25%, your downside 25%. And
but you're still doing a scenario. You're not just picking one.
Correct.
You're
still doing 2 or 3 scenarios, correct?
Yeah.
I think 3 scenarios makes a lot of sense in most cases. Absolutely. 7, no.
You're right. Yeah, because when you do that, it becomes speculative.
Oh boy, bad word in court.
Exactly.
Yeah, bad word in court. I like try to keep it as simple as you can. And it's hard to argue with 50-50 or 25-25 and 50. Best case, worst case, and base case. So,
but you're still using scenarios.
Exactly.
Okay.
Yeah, different scenarios. All right, a couple questions here. How do you handle large PPP loans without knowing if it will be forgiven in total? Don, what do you think?
I would be, my first question there would be, why? Because it sounds like maybe the situation is different than what I'm seeing with my clients, but if you don't know that the PPP loan is going to be forgiven, then either you haven't managed it properly, or things are so bad that you've had to use it for things that you're not allowed to use it for. Either scenario is not good. And in that situation, I would account it, if they really don't know, I'm going to call it a liability. Otherwise, what we're doing is we're looking at it as a non-operating item. So we value the operations, and then if they've got PPP and it's more likely than not that it's going to be forgiven, it's a non-operating asset.
Okay. Another question. When does
Or you're not subtracting it as a liability.
Correct.
Yeah.
I mean,
when does what we do just become guessing? Well, speculative and guessing are 2 bad words. I don't believe we're doing either one, but we're employing techniques that some people say we should have been employing all along. Probability scenario now has been around for a long time. And but it seems to have become more prevalent now that we have COVID.
Yeah, by the way, there is a mistake that some people make with scenarios. They think that somehow when you do a scenario analysis, you've eliminated the risk and the discount rate should be the risk-free rate. And all you're doing is estimating where the mean is and how big the variability is. It's still risky.
Yep, I agree. We're going to come back to that in a minute too, when we talk about discount rates. You're still stuck waiting the scenarios. You pitching for 3 scenarios? I've said I'm looking at 2 or 3. I'm reluctant to go over 3 because the more you add to it, I think the more difficult it is to defend, and the more speculative it looks. So appearance can matter. Another question: how are you handling the tax issues with the forgiven PPP, but the inability to deduct? right, I always do the same thing. Whatever the law is as of the valuation date, unless there's a strong impetus for it to change, or it looks like it's sailing through the Congress or will get through the Congress. I know that the AICPA has been lobbying the government about deducting the PPP or deducting the expenses that the PPP are being used for. But right now, that's not the law.
And I'm very and I'll do a scenario analysis that's low on the probability that it's going to become law to do that. They need the money for other things.
You're right. You're right. All right, let's go. Let's get into discount rates. Right now, I have read, obviously, I'll let you talk about it, Roger. I know that you came out with your recommended ERP, adding 1% and then lowering your normalized risk-free rate up to 2.5%. Mercer's out saying he's adding 1%. He didn't say where. And then one of his guys wrote an article where they were adding 1.5 to 2%. They were adding to the ERP and the company's specific risk. I'm going to let you clean up on this one, Roger. So I'm going to ask Chris first, then Don, and then Roger about, well, because obviously you wrote the cost of capital book. All right. But Chris, you go first, then Don, and then if you could clean up, Roger, in terms of the discount. Let's talk about only cost of equity right now. Chris?
Okay. I'll try to keep it brief. Most of the risk should be factored into the cash flows, not in the discount rate, but I would agree with maybe adding a 1%.
Where are you adding the one?
In risk-free rate, certainly not going with the valuation date risk-free rate that is minimal, going more with what Duff and Phelps is proposing.
So are you adding 1% to the ERP, 6%?
We would consider that, yes. And again, it depends on with the industry and how it's being impacted by COVID too.
And what about the risk-free rate? Are you using spot rates or normalized?
We would. It's more normalized. It would be more in the 2.5. I don't remember the number off the top of my head, but it's not the risk-free rate of the date anymore. It's too low.
Okay. Don, what about yourself? What are you adding for risk of COVID? I think we all agree we're risk affecting in the cash flows, but that doesn't mean you don't risk affecting the discount rate either. What are you doing in terms of the risk-free rate and also in terms of adding something back for COVID, whether in the ERP or in the company specific risk?
So with the risk-free rate, we figure there's people out there a lot smarter than us. And so we typically go with the recommended rate from Duff and Phelps. So we follow that. And then in terms of either ERP or company specific, we're looking at industry data. IBIS World has a thing online where they're explaining the effects on different industries from COVID and whether it's a low impact or a high impact. And we're using that to help us determine if we're going to increase our company specific risk related to COVID and the company that we're looking at.
Okay. And Roger, I'd like to ask you two things. You sent me an email last week or a little while ago about support for the what's called a synthetic rate by McKinsey, and I always call it the McKinsey book. And can you just tell the group, the participants here, how you go about coming up with the 2.5%? What other or for a normalized risk-free rate, and why we should be looking at it? And then also what you're I know that you said the recommended is 1% to the ERP, going from 5 to 6%, but are you adding anything more? But tell us about this recommended ERP. Tell us about this so-called synthetic risk-free rate. And then are you guys adding something in addition to that?
Okay, I've been writing and talking about this since the financial crisis. I coined the term normalized. McKinsey uses synthetic. It's recognition that at a specific date, two things could be occurring. One is a flight to quality. At certain times, what you see is massive movements out of equities into government bonds, not for yield, but for principle, safety of principle. And so, and the other thing is the actions of the Fed. And I think it's easier to understand that you have to abandon the spot rate if you were looked at the negative rates in some of the European countries. How do you start building your equity return with a negative number? So since the financial crisis, we track very closely two things. One is, what is the real rate of return and the movement of that? And there's models that, we didn't invent anything, that academics and the various Federal Reserve banks talk about what is the real rate of return. And the real rate of return is how much you sort of have to have a return just for letting people use the money with no risk of default. And the second thing is inflation expectations. And for that, we look to the surveys that are out there about what we think is inflation expectations. Now, one of the things that we try to take into account, and why the spot rate oftentimes is different than the synthetic or a normalized rate, is the actions of the Fed and movement. But what we're looking at, remember, when we're doing evaluation of a business, is a long-term average. So even if you think the inflation rate today, because there's so much a capacity that's available right now, and you have very low inflation, that doesn't mean that as recovery occurs, that you're not going to have inflation over the next 5-7 years. So we sort of track what the longer term inflationary expectations are. And there's a committee of us that do this. We review it every month. And one of the reasons we adopted this methodology, and that is, by the way, we have a convention. And the convention is, if there's not a 50 basis point movement in the total of the ERP plus risk-free rate, we don't consider it. And the reason is that we have found over time that things bounce around. So 1 month you're going to be down, it's going to decrease by 20 basis points, and the next month it's going to increase by 20 basis points. We have clients who do quarterly valuations, and you can't have discount rates bounce all over the place, decreasing it 1 month and then increasing it again the next month. So we've sort of adopted our own standard to sort of keep things, we want to see that the change is going to occur and sort of be more than just a monthly hiccup. And that's what we do. Every month we review the data, academic data. One of our staff is a PhD in finance, and he reviews articles consistently. We're trying to make sure that we're in sync with what the academics and the researchers at the various Federal Reserve banks are doing. And that's how we make our decisions.
Okay.
And everything that we did, you remember, when we increased the ERP, we said, well, this is the general market ERP increase. And you have to think, our whole discussion about doing scenarios and when we're going to get out of COVID tells us that the general risk level, the general variability of projections is greater.
Yeah.
And therefore the discount rate has to be greater than it was last December 31st.
Now, are you guys, are you adding anything in addition to the one, you got the 1% up for the COVID?
That's the whole marketplace, but then it goes back to
But
there
you
are
adding
industries,
anything
there are
more to a
industries that
specific company
need,
in a
there are
specific-
industries where the variability or the difficulty of making those projections are so high that you've got to, I hate to use the word, it's not a company specific, it's an industry specific adjustment.
Okay. And what do they, you have a general range of what you're seeing there? Is it another 1%? Is it 5%?
Yes.
Well, we have a range at least.
Yes.
And in this environment, that's not too bad.
Yeah.
All right.
Well,
Don,
Chris was talking about the cruise industry. Let's use that as an example. Who knows when their cruises will start again? More importantly, who knows when the public will accept that going back on board a ship is safe enough that in fact they can sell the number of tickets that they used to sell.
Yeah, one of the ways to do that is to look at bookings in the future, what's going on with bookings after COVID. But here's a question. I'll throw this to
Yeah, but
Chris.
you're going to see, even with bookings, you're going to see if we don't have a vaccine that is in massive distribution, those bookings are going to evaporate.
Yep. A lot of things will evaporate. All right, Chris, should we increase the projected corporate tax rates given the combination of recession, fewer tax dollars generated, government spending? Isn't this inevitable? I guess you could put in yesterday we had and the election.
Yeah. Well, I agree with that. The points that taxes will likely go up at some point in the future. I don't think any of us are in the business of speculating higher taxes at this point. So I'm going to use the current tax law, and if I'm concerned about that, then that's something I'm going to reflect in the discount rate for risk, as opposed to, I'm not going to go into trying to project what future tax rates are going to be.
Yeah, I agree. I mean, I stay with what, unless there's something going through the Congress.
Yeah.
And,
But I mean, not to bring up this topic that was disputed a few years ago, but with the TJCI, I mean, that passed, what was it, December 18th or 19th, a week or two before Christmas. But I don't think we knew even at the beginning of December that the corporate tax rates would end up at 21%.
No.
So.
Okay. All right, since the adjustments are industry specific, I think we're back to the discount rate. Should we expect some estimates from a panel of experts like you? Well, that's hard to do. We kind of jokingly said 1 to 5, but again, it's up to each. Well, boy, I almost said it depends. So,
Yeah. Again, I'll just comment again, somewhat repetitive, but everybody has. This is not difficult to do. Look at public company data. You can look at betas. You can create a little index. It's very easy to do. It's just taking the market cap of a selected group of companies and comparing it to an index. It's not any valuation analyst has the ability to do with a spreadsheet. And I think you just, and then I forgot if it was Roger or Jim who mentioned the McKinsey projections. You can look at things like that. There are tools out there, and it's part of our job. It's part of what we're being paid for.
yeah, I agree.
Our work has become more difficult. Our work has become more difficult.
Okay.
Yeah.
Don, what are you doing with minority interest and 100% controlling the interest in terms of DLOM? Are you changing the magnitude of your DLOM? Let's do minority first, and then let's do 100% control.
Okay, so minority, we're looking at volatilities. And those volatilities have increased, which are putting upward pressure on those DLOMs. So yeah, we're seeing higher discounts for lack of marketability because of that.
What about 100% control?
100% control. So I'm still of the opinion that that should be very low. If you have 100% controlling interest, I know my business partner thinks it should be 0. I'm somewhere between maybe 0 and 5% still, even at 100% controlling interest, just because of the control factors and being able to pull money out of the company and things like that. But I would probably push that more to the upper end of that range in the current environment.
Okay, Chris, what do you think? What do you do on minority and control and DLOMs?
All right, so for minority interests, I agree with Don. Increased volatility in the markets, higher DLOM in general. When we calculate a DLOM, we actually do 4 things. We do the traditional restricted stock benchmarking studies. We an expanded Mandelbaum, much more than 9 factors. We look at Plurus, or or FMV is another alternative. And we do 3 different securities-based approaches. The Finnerty, the Chaff, and the Asian put. And then we decide on a discount, and then we use the QMDM, and we look at we basically check with the QMDM. We basically will put in the inputs, and if those inputs make sense with our discount, that's our reasonableness check. We've been doing that before and after COVID. We do all of those things for every DLOM for minority interests. Okay. But generally speaking, they're a little bit higher now because volatility is higher. For 100%.
Roger, how do you feel?
Oh, do you want me to answer the 100%?
Oh, I'm sorry. Yes, I'm sorry. Go ahead.
So for the 100%, I generally don't. I might apply a smaller DLOM for call it a 70% interest, but for 100% interest, generally don't apply DLOM.
Yeah, anything less than 100%, I call it a nuisance factor. And I have fled plenty of litigation cases where someone owns 10% and the biggest pain in the ass that you can't imagine.
Right.
Yeah, so I would agree with that. Roger, what are your thoughts on DLOM, minority control?
Let's talk about the 100% control. It really depends on what are you comparing it to. If you're using multiples and discount rates from bigger public companies and applying them to smaller companies, you either have to make an adjustment because the multiples just aren't where they were for for smaller companies today because the risks are much higher. Or you have to apply a discount for lack of marketability. And we'll use that term, even though it is really an adjustment for the fact that we're pulling data from the wrong data pool to make an analysis of what the valuation. I mean, Don is smiling. I can imagine if you go to you've been up against somebody who's valuing this company that's got 6 million in revenue, and they're picking multiples from these big companies and without an adjustment. What do you do?
I look at it this way, is you're comparing to these public companies either through developing the discount rate or, public guidelines. And those companies can be bought and sold on a moment's notice. And when you have a privately held company, even if it's 100%, it can't be bought and sold as quickly. And you may have something in the interim period between now and when it can be sold that is detrimental to the value of your company. So that's a risk that doesn't exist with a publicly traded company.
It's really a
Yep.
discount for lack of liquidity too. I'm gonna get through the last three questions. Anyone on the panel using Pepperdine? I don't. I fill out the form every year. Pepperdine's a lot of very small businesses. It's not a large pool.
Yeah, I even look at it for small when I'm doing smaller companies. The issue is it may not exist soon because they have announced that they're going to cease, that Pepperdine University is ceasing supporting the effort.
Okay. Here we have D-Law. What's the D-Law for a 33% shareholder buyout? Well, Gil, you're going to have to retain one of us to tell you that and to spend a lot of time on it. Right now, it's very difficult to say what it is.
You got to look at the
and also, if you have a 1/3 interest and everybody else owns 10%, that's different than 1/3, 1/3, and 1/3. Go ahead, Doug. You wanted to say something?
Yeah, and I'm going to say something too.
I'm agreeing with you, and it also depends what are the rights and restrictions in the operating agreement and the organizational documents that are involved. So you can't, like you said.
And to add to that state law. And to add to that state law. Fair value.
There's a lot of factors.
Standard, there's a lot.
And the shareholder agreement, there is so many factors, but it's hard to give a range. And then so the last thing here, we have a comment. The adjustment for the multiples doesn't relate to the DLOM, really fundamental differences, risk and growth. I think volatility is something that is something we all have to look at. And with that, I'd like to thank Don and Roger and Chris and Colin. And Colin, I'll throw it back to you.
Thank you very much. That was awesome. I just love that open format where there's no script and we just kind of go off the cuff. That was fantastic. Well, that is also a wrap for another conference. And I hope you all enjoyed it and had a good time, and hope to see you sometime soon out on the internet very shortly. So have a great one. We'll see
Stay
you.
safe, everybody.
Thanks, everybody.
Bye.
Keep well. Thanks.